This week, I had the honor of speaking with none other than Howard Marks, legendary investor, best-selling author, and co-founder and co-chairman of Oaktree Capital Management, the world's largest distressed debt investor with over $180 billion in assets under management. Known for his sharp thinking on risk, cycles, and market psychology, Howard has become one of the most influential voices in global finance. His memos are read by investors all around the world, from retail traders to the heads of central banks. In his books, including The Most Important Thing and Mastering the Market Cycle, are considered essential reading for anyone in markets. In this episode, we spoke about his career, his philosophy on his investing, and the timeless principles that have guided him in building one of the most respected firms in the industry. I enjoyed this conversation, and I hope you guys enjoy. Thank you. Thank you for joining me, Howard. I really appreciate it, and thank you for making the time.
My pleasure to be here, Amir.
So I want to start off at your beginnings. So can you give me a little bit of background about your childhood? And were there any experiences during your childhood that you believed shaped the person that you eventually became?
Well, I was born in Queens, New York, middle-class family. My dad was an accountant, and we lived okay. I don't think there were any turning points in that period. It's just that I reflect now on the fact that my parents, having been born in the 1900s, were adults during the Depression. And I think that the Depression was a very scarring experience, and I think it scarred them. And so I ended up hearing things like, don't put all your eggs in one basket and save for a rainy day. And I think that made me a conservative person. And that's it. The rest of it was pretty much by the book.
If I talked to a 15-year-old Howard Marks, what would he say he wanted to do when he grew up?
Oh, at 15, I was probably either a history professor or an architect, something like that.
Yeah. I want to move on a little bit to your early career because I find that particularly fascinating. You started at Citi in 1968 and went from an equity research analyst at Citi to eventually senior portfolio manager in charge of the high yield debt and convertible bonds before you left in 1985. You described a stark difference between the two positions. So equity research, and then eventually the early days of starting kind of the overseeing high yield and overseeing convertible bonds. What were the differences like between the two positions? And what was it like being in high yield during the early days?
Well, the biggest single difference, Amir, was not between equities and debt. The biggest difference was that when I was in equity research, I was on a institutional bank bureaucratic career path, from junior analyst to senior analyst to unit head to director of research. So less than 6 years after I got to the bank, at the tender age of 29, I was made director of research. And I now realize that and I used to say that, well, my job was to know 2 sentences on 400 companies, which is very unsatisfying. I now view it that my job was a managerial job and not a doing job. And that's what I think I was unhappy with. And, I had this superficial relationship with all these companies. And I didn't know much about how money was made in the market because I had never practiced it. And I studied companies, but studying companies is only a small part of what's required. We were investors in the Nifty 50. The Nifty 50 did horribly. A new chief investment officer came in. He wanted his own director of research, and I was outplaced to the bond department. Now in the bond department, I don't have to know 2 sentences on 400 companies. I have to know everything on 30 companies. And I was ecstatic. And that's the difference between managing an organization and doing. And I was happy, and I was working in convertible bonds at first, which was an inefficient market niche that most people didn't care about or know about, and where you could get an advantage through hard work and skill. You can't get an advantage in the large cap equity business, in my opinion, or very few people can. And then I got a call in the August of '78 from the head of the bond department. He said, "There's some guy named Milken or something out in California. And he deals with something called high yield bonds. Do you think you can figure out what that means?" Because the client had asked for such a portfolio. And I was smart enough to say yes. And so I started my high yield bond investing in '78. That was essentially the beginning of that world. And, you know, as Malcolm Gladwell said in Outliers, it's great to be in at the beginning. That's demographic luck, which I experienced. So, you know, that high yield bonds provided the cornerstone for most of what Oaktree does today. And we've evolved from there, but in an organic fashion. And now we do a lot of things related to sub-investment grade credit.
You left Citi in 1985 and moved on to TCW. And in 1988, you started one of the first distressed debt funds at TCW with Bruce Karsh, who would eventually become one of your partners for starting Oaktree. What gave you the conviction to start this then niche strategy? And what was the reaction like at that point in time from your clients, your peers, and everyone else in the industry?
Well, you know, so at that point, Bruce approached me in '87. At this point, I've been managing high yield bonds for 9 years. And if you do that, you've had some experience. You know, you buy a bond at par or 100. Once in a while, they default and go to 10 or file for bankruptcy. And you go on the creditors committee, you work on the restructuring. And if you can negotiate well, and if your claim is valuable, you might end up getting 30. So, you know, when Bruce had this idea, it appealed to me immediately, because what if you could skip the 100 to 10 part and just do the 10 to 30 part? And so, you know, I hired him and we became partners. And, you know, I helped him raise his first fund. It was very controversial. You know, when I started in high yield bonds, people said, "What, are you crazy? You're going to lend money to companies that are rated single B?" But then when we started Bruce's fund, they said, "What, are you really crazy? Now you're going to buy the debt of companies that are bankrupt or destined to become bankrupt? How can that be smart?" And so I helped him raise that money. And his first fund, raised in October '88, was $65 million. Then we had a second closing when we got it up to 96. And we thought that was we thought that was a lot of money. And so but we had to, you know, in both cases, we had to row uphill. And it was hard lifting, and we couldn't raise much money. But the main rule in investing is that if you are willing to do things that nobody else is, you might get a bargain. And we did. And you know, that first fund had a very nice return and got us off to a great start. And Bruce, when we started, you know, Bruce was my junior partner, employee at TCW. But when we started Oaktree 30 years ago, we became co-equals, and we still are. And it's a great and rewarding partnership.
During those times, starting high yield and then being early in distressed debt, how did you maintain conviction when those strategies weren't mainstream yet?
I would say two ways, Amir. Number one, you know, people say, "Oh, it's great, it's safe, that's good," or "It's risky, that's bad." And those are like broad brush statements that are kind of irrelevant. Now, the Nifty 50 were considered to be such great companies, the best and fastest growing companies in America, where nothing bad could ever happen and there was no price too high. And if you bought those stocks the day I started work in September of '69, and if you held those stocks tenaciously for 5 years, you lost about 95% of your money. So obviously buying high quality assets is not the key. And I reached the conclusion that success in investing doesn't come from buying good things, but from buying things well. And that there are no assets which are so good that they can't become overpriced and dangerous. And there are very few things that are so bad that they can't be cheap enough to be attractive. And that's really, so I just grasped, maybe it was a result of my Nifty 50 experience, but I grasped the fact that sure, high yield bonds and then later distressed debt weren't great credits, but if you buy them cheap enough, it's worth doing. And that's the way it turned out. The other thing is, people say, oh, that you could have defaults in high yield bonds, so you shouldn't do it. You have to quantify these factors. The mere fact that you could have a default itself is not crippling. In 81, a news network asked me, how can you buy high yield bonds when you know where some are going to default? And I said to the reporter, most conservative companies in America are the life insurance companies. How can they insure people's lives when they know they're all going to die? Same thing. And the answer is you can take risk intelligently. If you think about it, if you can quantify it, if you can diversify it, and if you're well paid. And that's what we've done now for 47 years with success. So, the life insurance company doesn't sell insurance policies without expecting people to die. They build that into their thinking. So when you invest in low quality bonds, you assume that you'll have some defaults, and you compute the impact relative to the compensation you receive for bearing the risk. And it's not good or bad, in or out. Is it risky? How risky? What's the expected return? Is it sufficient to compensate? And so, I set up numerical tools to do that.
You left managing $7 billion with Bruce Karsh at TCW, which still is a lot of money, but at that time was a humongous amount of money, to start Oaktree from the ground level. Why did you leave to start Oaktree? And I'd love for you to describe the early days, kind of like the building days, what it was like at that time.
Well, TCW had 50 different strategies that ran 50 different ways. And we had a few strategies which all ran the same way, and we considered that to be our way and the right way for us. And we wanted to be in an organization that only did a few things our way. Bruce and I and the three other founders of Oaktree at that point, 95, had worked together for an average of 9 years. So we knew we liked each other. We liked working together. We knew we shared values and respected each other's ability. So we knew we could have a pleasant, harmonious experience. And then there were the normal reasons to leave. The boss at TCW was a little capricious, and he liked to push you around a little bit, which wasn't great. And when we started making a lot of money through the carried interest on our distressed debt fund and related funds, and they wanted a certain percentage of that, which we felt they weren't doing anything to create, that became, I would say, the impetus for leaving. And so, when we had $7 billion at TCW, by the end of the first 9 months, we had brought over $5 billion of that to Oaktree. So, I think the clients also viewed that we had done a good job for them at TCW, and there's no reason we should do less well for them at Oaktree.
What do you see as the key moments or turning points that led to what Oaktree is today? Were there any specific moments that you think really made it take off or something along those lines?
No, it wasn't that kind of thing. It wasn't like there was a big bang moment that made us successful. We just continued to practice the skills we had practiced at TCW. We continued to have good, steady results. Bruce's results were exceptional. We started Oaktree in '95, and there was a crisis in '01 that we did a good job in, and so forth. But it wasn't, there wasn't a turning point or an inflection point. If you want to look at a moment, I think the most important thing was that, we had the tech bubble, internet bubble of '98, '99, early 2000. And then it burst in mid 2000. And the stock market, the S&P, was down in 2000 and in 2001 and 2002. So that was the first 3-year decline of the S&P since the Great Depression, 1939. And so people kind of fell out of love with the stock market. The Fed cut interest rates to combat the recession that was taking place. And interest rates were so low that they fell out of love with bonds. And so they needed something. First, they tried hedge funds. And then they tried private equity. And these things developed the following. And from that moment, let's say 04, 5, 6, the area called alternative investing was born. There was no name alternative investing before that. It was a name that was arrived at to describe things other than stocks and bonds. And so everybody in 05 says, hey, let's do something called alternative investing. And guess what? We were there. We never said, in '95, we didn't say in 05, everybody's going to want to start into the things we do. We just did our thing, and it turned out to be a destination. That's the second example, and I've had many, Amir. That's our second example of what Gladwell calls demographic luck: right time, right place. We were in a place. We didn't pick the place based on a projection. We were in a place, and it turned out to be the good place. And that really, that's why, we had 5 billion when we started Oaktree. We might have had, I don't know, 25 billion, 3, 4, 5 or something like that. But then people decided to pursue this thing called alternative investing, and that's why we have 200 today.
What makes a great investor? What are some characteristics that make a great investor?
Well, first of all, of course, you have to be numerate and analytical. Beyond that, great investors come in all shapes and sizes. Some are colorful, some are plain, some are conservative, some are aggressive. I think that some are emotional, some are placid. But what it comes down to is a special insight, the ability to look at an investment and understand its potential and understand the probability that the potential will be achieved and understand the risk of failure and put those things together into an equation. It doesn't have to be a mathematical equation, where you can conclude that the upside potential more than merits taking the downside risk. That's what it all comes down to. Now, you can be a conservative person and do that with high yield bonds. You can be an aggressive person and do it in the venture capital business or with rapid growth stocks. But no matter what your personality is, and no matter what your predilection is as to behavior, I think you're not going to be a successful investor if you can't figure out which things there are where the upside more than compensates for the downside. In short, the way I describe it, I describe investment performance as like there's a bag and has a bunch of balls inside the bag, like lottery balls. And fate reaches into the bag and pulls out a ball. the balls in the bag are all the possible outcomes. The one that's pulled out is the actual outcome. You pull one, fate pulls one outcome from a range of many possibilities. If you get a black ball, that's good. If you get a white ball, that's bad. A black ball's a winner, a white ball's a loser. And yet you don't know which ball fate is going to pick. I think that, but the way I think about it is that the superior investor has a better sense than others for the balls in the bag. The better, you know, through some analytical process or just thinking about it or some insight, the superior investor knows when there's 75% black and 25% white and it's worth playing, and when it's 25% black and 75% white and it's not a good idea to play. I think that's what it's all about.
You bought some of the greatest companies in America, as you previously described, through the Nifty 50 when working at Citi, and lost money on a lot of them. You describe Oaktree as buying the worst public companies in the United States, but for great prices. When does price matter?
Always. Price always matters. As I said a couple of minutes ago, there's nothing so good that you can buy it without price. And, you know, these are the lessons that I learned in my first decade. And, you know, you only learn from success, from failure. You don't learn anything from success. And hopefully when you experience unsuccess, you look back and you try to figure out why. And what was the problem with the Nifty 50? The problem was some of them were great companies. Maybe most were great companies. But who came up with this idea that it didn't matter what price you paid? Which was really, I would say that was the official dictum. And so now I don't think anybody buys without regard to price.
Yeah.
The world has gotten a little smarter.
Most people have the same data when it comes to investments, but what makes great investors is extracting the importance from that data and understanding the qualitative factors. When narratives and statistics, the data diverge, which one do you primarily listen to?
Well, as you say, everybody has the same data. You have to go above and beyond the data to insight. You have to, you know, my son Andrew, who's this great venture capitalist, when we lived together during the pandemic, when we discussed investing ad nauseum and debated value investing versus growth investing, you know, he made the point that readily available quantitative information about the present cannot make you a success, because success comes from outperforming, and everybody has the same data. So merely possessing the data can't make you a success. To be a superior investor, you have to either do a superior job of understanding the implications of the data, what's going on at the company that you see that others don't, or understanding the qualitative factors surrounding the company, the quality of management, the quality of the product pipeline, the quality of the research effort, or what have you, or understanding potential future. In other words, you have to do a superior job of assessing information that is not readily available and quantitative.
Yeah. I want to move a little bit on to kind of, I've asked this to a couple of people who've had successful partnerships, and I'm very interested in the specific topic. You and Bruce Karsh together have built one of the largest alternative asset managers in the world. What makes a great partnership, and what's your relationship like with Bruce?
Well, it is a great relationship. It's one of the greatest things in my life. You know, after my family and some of my friends, my work experience, and especially my partnership with Bruce is paramount. And I wrote a book in 2011 called The Most Important Thing. It was based on a memo that I wrote around '02 called The Most Important Thing. And what they both had in common is that in every chapter of the book and every section of the memo, it starts off, the most important thing is, and then it's a different thing. Because there are so many things that are important. You can't just say one. But in the memo, I didn't put it in the book because it's not about investing. But in the memo, I talked about the importance of having a great organization. And I talked about what makes a partnership great. And what I said there was shared values and complementary skills. I can't imagine being partners with somebody where I have a difference of opinion over values. I'm conservative. He's a wild man. We're going to have a big problem coexisting because I'm going to hold him back when things go well, and he's going to get me killed when things go poorly. I have integrity and he doesn't. So it's going to kill me every day to see him cutting corners. So it's really, in my opinion, not a good idea to partner with somebody, whether it be in business, in domestically, or friendship, where you don't share values. On the other hand, you should have different skills, and they should be complementary. I've seen lots of partnerships fall apart because one guy says, I can do everything he can do, and everything I can do. What do I need him for? And so, the beautiful thing about the relationship with Bruce is that we have different skills that complement each other and different styles even. I mean, Danny Kahneman wrote that great book, Thinking Fast and Slow, about behavior. Now, I happen to think, and he thinks we have both, and they come together. But I think that for the most part, I am a fast thinker, and Bruce is a slow thinker. And I reach quick conclusions based on impression, and then I'm mostly done. And Bruce thinks it over for a long time, reaches his conclusion analytically and gradually and process wise, and then tells me his opinion. And then he comes back the next day. He says, "You know what? I thought it over some more, and I changed my mind." So this is complementary. Bruce is a great analyst, and knows how to squeeze every penny out of an investment position. My approach is more conceptual and less quantitative and less analytical. I like to travel the world telling people what we do and trying to convince them that Oaktree would be a good place for them to put money. Bruce is happier staying back at the headquarters and directing the investment operation and making investments himself. So it really is complementary, and so that has led to a great partnership. Now, I will say, however, that the bedrock of the partnership is mutual respect and affection. And I don't think you can have a successful partnership with somebody you don't respect.
I completely agree. I want to move on to some of your lessons you've learned, and you spoke about, you briefly highlighted that you are the more client-facing of the part of you and Bruce.
Right.
Your clientele includes, I'll list this off, but it's very impressive. 65 of the largest 100 U.S. pension plans, 40 state retirement plans in the United States, over 500 corporations and or their pension funds, over 275 universities, charitable and other endowments and foundations, and 16 sovereign wealth funds. I assume you speak to hundreds, if not thousands, of people all over the world, including your clients. What are a couple of the greatest lessons you've learned from your clients?
Well, I think the important thing is, you can't go to see somebody and prescribe medicine without knowing what condition you have to treat. So there is no solution that's right for everybody. There's no investment product that's right for everybody. You have to understand the client's needs and then understand how the things you can do can fit into those needs. And that's really important. And then the other thing is, that many of the, if you list off those clients, pension funds, corporations, endowments, universities, sovereign wealth funds, these people are hired executives running money that's not theirs. And you have to understand what their payoff table is, what their incentives are, what, how their behavior will be viewed in their setting. And you have to help them achieve performance that will accomplish the goals of their organization and themselves.
You spent a lot of time with the late Charlie Munger, as you both lived in Los Angeles. What was the greatest or some of the greatest lessons that you've learned from him?
Well, we rarely talked about investments or financial statements or money. We talked about things going on in society, philosophy, politics, reflections from all walks of life, all forms of endeavor. Charlie was eclectic in his thinking, not narrow, and made life interesting. That's number one. Number two, he had a great sense of humor. He loved to laugh, and he loved to make people laugh, and he had a real belly laugh, and he was fun, and I try to do the same. Charlie had incredible integrity. He wouldn't cut a corner if his life depended on it. And he was very outspoken about what he believed and what he didn't believe, and he didn't cut his cloth to fit the situation. I think those were the most important things, and honesty. He always said exactly what he felt, and of course, I only knew him. It seems funny to say, but I probably only knew him for the last third of his life. Years, let's say 65 to 100. He came within weeks of making 100. And so I don't know how he was all his life. I suspect he was this way all his life, but he said exactly what he thought. And he wouldn't say something or not say something just to be palatable or just to get ahead. And I think that's an enviable position to be in, which he certainly was in. And I think it's a good goal for all of us to try to get to that position.
I've been very interested in this question. I've been asking it constantly throughout the past couple of months, because in this day and age, there's so much media, there's so much noise. So I like to see where people kind of gain insight from. So first of all, what does a day in the life of Howard Marks look like? And also, what does your information intake or inflow look like through the day? What do you read? What do you listen to? Yeah.
I read the New York Times and the Wall Street Journal. You get a very different account of most things. And if you read the op-ed pages, you get very different opinions. I watch some TV news. Much of the rest, what I get is from my partners and friends, what they see. And of course, all the stuff you see on the internet. And the problem today isn't accessing information. It's trying to weed out what you should look at, what you shouldn't, because you can waste enormous amounts of time if you try to ingest it all. But as Charlie used to point out, knowledge does not consist of batting back a bunch of data or facts. Knowledge consists of taking a modest number of facts and drawing the right inferences. And that's what I try to do. So I just try to observe my surroundings and get a feel for what's going on around me. Are people behaving too optimistically, in which case prices are likely to be high relative to intrinsic value, or are they too pessimistic, in which case prices are expected to be relatively low relative to intrinsic value? And I think that it's really a matter of observing and drawing inferences.
Are there any non-negotiable activities during your day that you constantly do and that you think keeps you sharp? Or is it just different depending on the day?
Well, the main non-negotiable is for me is eating. You know, I like to eat breakfast, lunch, and dinner, and I'm not like a camel that can go days without water. Um, uh, I like some relaxation and some quiet time. If I have to give a talk in an arena or something, I like to get there a little bit early, and I like to sit still by myself and maybe do a couple of puzzles. I like to solve word puzzles, crosswords and spelling bee and Wordle and things like that. And I find them very relaxing. I was once on a program, and the speaker before me said that some people derive energy from other people, and some people derive energy from being alone. And I'm more of the latter. And so I like my quiet time. And I don't like to be in conversation all the time. And I dare say very few people pop into my office, to gab about that weekend's games, and I just find I can get a lot more done if I don't engage in that kind of small talk.
I can relate. I'm more of the not on the can get more stuff done. I'm obviously not as busy as you, but on the kind of spending quiet time by myself part. And this is a question we ask every single one of our guests. If you had to give one piece of advice, whether it be investing advice, career advice, life advice, to a 15-year-old today, what would it be?
That's easy for me because I have a favorite quote on the subject, Amir. Christopher Morley, the writer, said, "There is only one success, to be able to live your life your own way." And what that means is you must not allow your course to be charted by society, your friends, your parents, or what's popular, or peer pressure. Now, it's not. I talk with people like you who are intelligent, motivated. Look at you. You're doing all the work to do this podcast, and you're asking intelligent questions, and we're having what I consider an interesting chat. You could do almost anything you put your mind to. The challenge is figuring out what it is. So Morley says, success to be able to live your life your own way. What is your way? That's the question. That requires introspection. People call me up and they say, "Oh, I'm starting college, and after college, I'll probably work 4 years, and then I'll get an MBA. So 10 years ago, 10 years from now, what asset class should I go into?" I have no idea. Nobody knows what asset class is going to be profitable 10 years from now. But they should sit there and think, well, what's good for me? And so what I tell people is try to find an activity that will play to your strengths, avoid your weaknesses, and make you happy. And I believe, and I use the word happy. I believe we only get one life. I'm hoping there's an exception, but I think the goal is to make that a happy life. And I don't think the answer is doing what society wants you to do, or making the most money, or working every waking hour. But you have to balance work, family, friends, hobbies, other pursuits, activity, rest, in a way that works for you. And as I say, the hard part is to figure what that is. And by the way, it's especially challenging because, when you're twice your current age, it probably won't be the same. And that makes it really hard to hit a moving target. But what kind of person are you? And like the old saying goes, what do you want to be when you grow up? I think it was Charlie, could have been Warren, but I think one of them said, write out the obituary that you want published when you're dead, and then you live your life to deserve it. And I think that's good advice. So I'll quit there.
I remember I've heard that quote before, and I think I've asked this question. This is my 17th time, and this is by far the favorite answer I've ever gotten. So thank you for coming on, Howard. I really appreciate it. I've enjoyed this conversation. And again, thank you for taking the time.
Thank you, Amir.